Welcome to the Deep Dive. Today we're tackling Opendoor. It's definitely a hot topic, lots of buzz online. The big question seems to be, is this just another meme stock frenzy, or is there, something more solid underneath? People have asked us, how do you even value it? What's the real potential? And yeah, what are folks actually saying on places like Reddit? So we've pulled together some sources to try and get to the bottom of it.
Exactly. We've got some academic theory on valuation, which is crucial. Then there's a look at Opendoor's place in the whole real estate tech landscape. And yeah, that Reddit discussion gives you a real pulse check. The goal here is to give you the tools, really, to look at this from different angles, move past the headlines.
Okay, let's do it. Let's see if we can find those aha moments. So let's kick things off with that Reddit source. It's got this pretty provocative title. Opendoor's new chairman wants to slash 85% of bloated workforce. I don't know what most of them do. I mean, wow.
Yeah, that definitely got attention.
The post itself is tagged humor, but dive into the comments. And it's a real mix. You've got outrage, people defending him, some pretty sharp questions about the company, the leadership. It's a snapshot of public feeling, right?
It really is. And the reactions were immediate, very polarized. Lots of people were highly critical, calling it a very bad, quote, embarrassing. Some questioned his competence flat out, like, if you're the CEO, Sick, and you don't know what your workers do, you're not a very good CEO.
Which feels like a fair point on the surface. Leadership should know, right?
That's the sentiment, yeah. But then others jumped in with a different take. Some pointed out, he's been the CEO, Sick, chairman for a day. Maybe cut him some slack.
Give him that, yeah.
Others were more blunt, saying things like, workforces are bloated, Opendoor probably doesn't need 1,400 people, and this idea that, most tech companies have huge bloat anyway, so maybe it's just stating the obvious, however clumsily.
Right. Is it chaos, or is it a necessary, if maybe poorly communicated, step towards getting lean?
That's the core question it raises. And you saw comparisons pop up immediately to Elon Musk at Twitter. The narrative for some there was slash payroll, yet improve the product.
Right, the cutting the fat argument.
Exactly. Suggesting these kinds of aggressive cuts can actually be bullish, more profit, better margins, helps the bottom line.
But then you have the other side, the deep skepticism. Like, where's the actual value here? Comments like, Opendoor is not a value play, or people trying to figure out where anyone finds value besides the pump and dump hype train. That perception is strong.
Be very strong.
And that one comment about the previous CEO leaving when the stock hit $5.
Yeah, suggesting she knew it was a pile of shit and got out. That's pretty cynical.
It paints a picture, though.
It does. And someone joked it's the old blame your predecessor, restructure, write 3 new envelopes routine. Which kind of highlights the challenge, right? Is this real strategic change or just shuffling deck chairs? The Reddit thread shows the market just doesn't agree on what's happening with Opendoor.
Okay, so the Reddit crowd is definitely divided, lots of strong opinions. Let's try to ground this a bit. How do we move beyond the chatter and actually figure out what a company like Opendoor is worth, fundamentally speaking?
Right. This is where the theory comes in handy. Our NYU Stern source on discounted cash flow, or DCF, valuation gives us the framework. It really boils down to, 3 main things.
Okay.
You need the discount rate. That's what return investors demand for the risk they're taking. You need the cash flows, the actual money the business generates. And you need the growth, how much those cash flows are expected to, grow over time.
So basically predict the future money, then figure out what that future money is worth today. Simple concept, hard to execute, I imagine, especially for Opendoor.
Extremely hard. The discount rate is key. Higher risk means a higher rate, which makes those future dollars worth less today. And cash flows, we're talking about what's left after reinvestment, either for equity holders or the whole firm. Get any of these wrong, the rate, the cash flow estimates, the growth prediction, and your valuation can be way off. And for a company like Opendoor, with all the uncertainty we just talked about, those errors get magnified. It's super sensitive to the assumptions you make.
I like that point in the source about the Chinese symbols for risk being danger and opportunity. Feels very relevant here.
Absolutely captures the essence of Opendoor right now.
Okay, let's dig into those inputs a bit more. They seem critical. Starting with the discount rate, how do we measure that risk?
The standard tool is something like the Capital Asset Pricing Model, CAPM. It starts with a risk-free rate, then adds a premium for market risk. And that premium is scaled by the company's beta.
Beta. That's how much the stock moves compared to the overall market, right? So high beta means more volatile.
Exactly. Higher beta, higher expected return needed, higher discount rate.
So for Opendoor, with its ties to the volatile real estate market and being a tech company,
Mm.
you'd expect a pretty high beta.
You would. Now, just calculating beta from past stock prices can be tricky. The source points out issues like maybe the market index isn't broad enough or the history doesn't reflect recent changes in the company.
Like a big restructuring, for instance.
Precisely. This is where a bottom-up beta comes in. It's often more reliable.
Okay, what's that involve? Bottom-up beta.
Instead of just looking at stock prices, you look at the company's actual business. What industries is it in? How much operating leverage does it have meaning? How much do fixed costs magnify changes in revenue? And how much financial leverage, like debt?
So you build a risk profile from the ground up based on its operation.
Exactly. Like the source mentioned, Disney's beta was 1.40, higher than average risk. Makes sense for entertainment, cyclical business.
Right. Okay, so that's risk. What about the cash flows? You mentioned free cash flow.
Yes, free cash flow to equity, FCFE, or free cash flow to firm, FCFF. This is the cash left after the company makes necessary investments for future growth, things like buying equipment, building warehouses, changes in inventory, that sort of thing.
So it's not just profit. It's profit minus what you need to spend to keep growing.
Correct. And here's a key point. Even a company with negative free cash flow isn't automatically a bad investment.
How so?
If they're heavily reinvesting that money wisely for future growth, it could be a very good sign. Think young, high-growth tech companies burning cash to scale up.
Okay, so negative isn't always bad. Depends why it's negative. Crucial for Opendoor, I guess.
Very crucial. And then finally, growth. How do we estimate that? Past performance isn't always the best guide.
Definitely not for a company potentially undergoing big changes.
True. History is a start, but the source emphasizes looking at fundamental growth rates. This ties growth directly to two things: how much the company reinvests back into itself,
Okay.
and what kind of return it earns on those investments. So for earnings, it's about the retention ratio times return on equity, ROE. For operating income, it's the reinvestment rate times return on capital, ROC.
So growth isn't magic. It comes from putting money back in and getting a good return on it.
At the end of the day, yes. No firm can grow forever without reinvesting. Estimating those future reinvestment rates and returns for Opendoor. That's the multi-billion-dollar question.
All right, so we have the theory. Now let's try and put Opendoor in context. Where does it actually sit in the wider real estate tech world? We have that industry report.
Yeah, the Real Estate and Construction Technology Report gives a great overview. It shows that, okay, multiples for public companies in this space did recover a bit in 2024. But importantly, they still trade at a discount compared to the broader software index.
So the market generally values pure software more highly than tech applied to real estate or construction.
Seems so. The overall index for real estate and construction tech is trading around 6.2 times estimated 2025 revenue. Compare that to 9.8 times for the general software index. Quite a gap.
Interesting. And does it vary within the real estate tech sector?
Oh, hugely. The report breaks it down. Companies dealing with diversified data, they trade high, like 10.4x revenue. But then you look at short-term rentals or online travel agencies, Strodas, they're way down at 1.2x revenue.
Wow, big difference. What drives that?
Generally, companies with better revenue growth and, crucially, higher EBITDA margins get the premium multiples. They mention the rule of 40.
Oh, yeah. Revenue growth rate plus profit margin should hit 40% or more. A classic SaaS metric.
Exactly. It's a quick check for healthy growth and profitability combined.
So where does Opendoor fit in this landscape? The report put it in the listings subsector.
That's right. Alongside familiar names like Zillow and Redfin, and this is where it gets really stark for Opendoor, the report shows its EV enterprise value to estimated 2025 EBITDA is NM, not meaningful.
Not meaningful. What does that signify? Just bad.
It signifies that the estimated EBITDA for 2025 is negative or so close to zero that the multiple doesn't tell you anything useful. It's basically undefined or nonsensical.
Okay, wow.
And backing that up, the estimated EBITDA margin for Opendoor in 2025 is negative 1%.
Negative 1%. Okay. How does that compare to, say, Zillow in the same category?
Big difference. Zillow's listed with a 28x EBITDA multiple and an estimated EBITDA margin of 38%.
38% margin versus negative 1%. That really highlights the challenge, doesn't it?
Yeah.
No wonder Redditors are skeptical if those are the numbers.
It frames the skepticism perfectly. And remember, the broader market context isn't exactly helping Opendoor's core business right now. Mortgage rates ticked up again. Affordability is a huge issue keeping homeownership rates down.
Right.
And even though home prices shot up massively, like 31.6% between early 21 and late 24, The actual number of homes sold collapsed by over 40% in that same period. Volume is way down.
Less transactions means less business for an iBuyer like Opendoor.
Exactly. Plus, there's that underlying structural housing shortage, about 3.5 million homes short. It's a tough environment for their model.
But, okay, the report wasn't all negative on this sector, right? It mentioned some tailwind.
Absolutely. There are powerful forces pushing real estate tech forward. Digitization is accelerating across the board. AI adoption is huge. McKinsey thinks generative AI alone could boost operating margins by up to 10% in the industry. That's massive potential value creation, like 110 to 180 billion dollars.
Wow, okay. So AI could be a game changer for efficiency.
Potentially. Plus, there's a focus on tech for labor and supply chain issues in construction, improving macroeconomic outlook generally, more M&A happening. And private equity has a lot of capital they need to deploy, so the report suggests high-quality assets in the sector could still do well. The potential is there.
Okay, let's try and connect these threads. We have the Reddit buzz, the valuation framework, the market reality check. So back to the core questions. Meme stock or more? How do we value it? How high could it potentially go?
Well, that Reddit discussion about layoffs and bloat, it plugs directly into our DCF valuation. If that chairman's plan to cut 85% of the workforce actually works, if it leads to real efficiency gains like some Redditors hope,
Then cash flows improve.
exactly. It could dramatically change the projected operating margins, move that -1% idea into positive territory that would fundamentally alter the cash flow projections in a DCF.
So the Reddit argument about layoffs, more profit, isn't just hot air. It's actually a potential input for a fundamental valuation model. It could change the numbers significantly.
It absolutely could, if it translates to sustainable efficiency, not just cutting muscle. But the flip side is that deep skepticism we heard on Reddit. It highlights the execution risk. Can they actually pull it off?
Right.
And will the market believe they can? To be seen as a genuine value play and not just a pump and dump, Opendoor needs to show a clear, credible path to sustained profitability and positive cash flow, not just talk about cuts.
And that ties into the how high can it get question. It feels like a tug of war. You've got the headwinds in the housing market, high rates, low volume pulling down on their core business.
Definitely a drag. But then you have the potential tailwinds for the broader real estate tech sector pulling it up. Digitization, AI efficiency gains.
So if Opendoor can successfully harness that tech, streamline operations, get those margins positive like Zillow,
Then, yes, theoretically, its valuation could significantly improve. It could move away from that not meaningful EBITDA multiple towards something more respectable, maybe closer to peers, maybe even getting some credit for being a tech innovator.
it really hinges on bridging that gap, doesn't it, between the current negative margin reality and the potential promise of tech disruption in a huge market.
That's the entire story. Can they navigate the danger, the tough market, the execution risk, to seize the opportunity presented by technology and market digitization? And high risk, potentially high reward.
And the valuation exercise, the DCF, is basically our tool to try and quantify that balance between the danger and the opportunity based on the best projections we can make.
Wow. Okay, what a fascinating look at Opendoor. We've definitely gone from the Reddit forums to the financial models and back again. Yeah, it really shows you can't understand a company like this just by looking at one piece. Not just the stock chart, not just the headlines, not just the fundamentals in isolation. You have to see how the operational stuff, like potential layoffs, connects to the market trends, and how both feed into that rigorous financial analysis like DCF. That's how you get a clear picture.
So the key takeaway for you, our listener, might be this. Next time you encounter a stock stirring up a storm online, try to dissect it like we did today. Ask, what's the online buzz really telling me about perception, about potential risks, or maybe hidden opportunities in operations? Then ask, what are the core valuation drivers? What levers, discount rate, cash flows, growth actually determine its fundamental worth? And finally, how does it fit into its industry? What are the headwinds and tailwinds shaping its future?
Exactly. It's that combination of perspectives, the street view, the financial view, the industry view that helps move from just being informed to having real insight and maybe helps you decide if something is truly undervalued or just, well, hyped.